What's the secret behind Warren Buffett's colossal wealth? Ever wonder how he managed to amass such a fortune? To unravel this enigma, let's take a trip back to the humble beginnings of the Oracle of Omaha. Born in the heartland of America in Omaha, Nebraska, Warren Buffett was not an ordinary child. From selling chewing gum and Coca-Cola door to door, to investing in stocks at the tender age of 11, Buffett's fascination with finance was evident from an early age. His journey took a significant turn when he stumbled upon a book titled The Intelligent Investor by Benjamin Graham. This book, which became the cornerstone of his investment philosophy, introduced him to the concept of value investing, buying stocks for less than their intrinsic value. His investment strategy, however, is not solely about picking undervalued stocks. His genius lies in his extraordinary patience and his steadfast belief in long-term investing. He once said, "If you aren't thinking about owning a stock for 10 years, don't even think about owning it for 10 minutes." This principle has guided his investment decisions for over half a century. But there's another key ingredient to Buffett's wealth: the magic of compound interest. Often referred to as the eighth wonder of the world, compound interest is the process where your earnings generate even more earnings. You earn interest not just on your investment, but also on the interest that investment has already earned. Buffett's ability to understand and harness the power of compound interest has been instrumental in his success. His approach to wealth accumulation is a testament to the power of discipline, patience, and long-term thinking. It's not about getting rich quick or gambling on the next big thing. It's about investing in value and allowing time and compound interest to do their work. So, the secret behind Warren Buffett's success? Patience, long-term investing, and the magic of compound interest. Compound interest. It's been called the eighth wonder of the world. But what is it really? In its simplest form, compound interest is the interest you earn on your interest. It's like a snowball rolling down a hill, gathering more snow with each roll. The snowball represents your initial investment or principal, and the snow it picks up along the way is the interest. As the snowball rolls further down the hill, it grows larger and faster, just like your investment grows with time due to compound interest. Imagine you've got a piggy bank. You're saving $1 a day, and at the end of the day, you've got $1 in your piggy bank. Now, let's say that this piggy bank is magical. At the end of each day, it adds an extra 10% to whatever amount is inside it. So on the second day, you don't just add another dollar, you also get an extra 10 cents from the piggy bank itself. The third day, it's not just another $1.10, but another 21 cents. That's compound interest at work. The secret here is time. The longer you leave your money in the piggy bank, the more it grows. This is because the interest is calculated on the initial amount you put in, plus all the interest you've already earned. So each day, your piggy bank is adding more than the day before. Over time, this increase can become quite substantial. Think of compound interest as a powerful tool in your financial toolkit. It's like a faithful ally, working silently in the background, growing your wealth bit by bit. It's the driving force behind the saying, "Make your money work for you." And here's the best part: anyone can use it. You don't need to be a financial wizard or have a huge amount of money to start with. What you need is patience, discipline, and a good understanding of how compound interest works. Remember, compound interest is your friend. The sooner you start investing, the more time your money has to grow. Warren Buffett didn't become a billionaire overnight. His wealth is the result of smart, long-term investing. Let's delve deeper into the concept of long-term investing. Now, you might be wondering, what exactly does it mean? Simply put, long-term investing is a strategy that involves buying and holding assets for an extended period of time, often for several years or even decades. This approach is based on the belief that over the long haul, good investments will yield positive returns, despite short-term market fluctuations. Buffett's approach to investing is akin to planting a seed and patiently waiting for it to grow into a tree. It might not be as exciting as chasing the next big thing, but it's a proven strategy that has stood the test of time. But how does Buffett decide where to plant his seeds? He's famously selective, preferring to invest in companies with a strong track record and solid fundamentals. He looks for businesses that he understands, that are within his circle of competence. He avoids the speculative, the flashy, and the complex, sticking instead to the tried and true. Buffett's preference for such companies is not just because they're likely to grow steadily over time, but also because they're likely to weather financial storms. When the market takes a downturn, these robust businesses are more likely to bounce back. They have what Buffett refers to as a moat, a protective barrier that keeps competitors at bay. The Buffett way is not about making a quick buck. It's about making wise choices and sticking to them. It's about having the patience to let your investments grow and the discipline to keep your emotions in check. It's about understanding that the stock market is not a casino, but a marketplace where businesses are bought and sold. And so, in the words of Buffett himself, our favorite holding period is forever. Long-term investing, it seems, is the way to wealth. It's not flashy, it's not quick, but it's proven and it's reliable. Just like Warren Buffett himself. Warren Buffett isn't the only financial guru with valuable advice to share. Let's delve into some golden nuggets from other financial experts. We start with Jack Bogle, the founder of Vanguard Group and the champion of low-cost index funds. His investing philosophy is simple yet profound. Bogle believed in the power of simplicity and cost efficiency. He advised investors to opt for low-cost index funds as they provide broad market exposure, low operating expenses, and low portfolio turnover. He famously said, "Don't look for the needle in the haystack, just buy the haystack." Next, we have Ray Dalio, founder of Bridgewater Associates, one of the world's largest hedge funds. Dalio is a strong advocate for diversification. He argues that it's not enough to just invest. One must diversify their investments to manage risk better. Dalio's all-weather portfolio strategy suggests a mix of 40% in long-term bonds, 30% in stocks, 15% in intermediate-term bonds, 7.5% in gold, and 7.5% in other commodities. This approach, he argues, will weather any financial storm. Lastly, let's talk about Robert Kiyosaki, the author of Rich Dad, Poor Dad. Kiyosaki emphasizes financial education and the importance of understanding how money works. He believes that financial literacy, not just making money, is key to building wealth. He encourages individuals to learn about investing, real estate, and starting businesses as a way to achieve financial independence. These are just a few of the many financial gurus out there with valuable insights. Each of these experts has their unique approach to money and investing. The common thread among them, though, is the emphasis on education, understanding risk, and making informed decisions. These tips from financial gurus can guide you on your path to financial success. Remember, knowledge is power. We've covered a lot of ground today, from Warren Buffett's wealth secrets to timeless money tips from other financial gurus. Let's take a moment to recap some of the key insights we've gleaned today. Firstly, we delved into the secret to Warren Buffett's wealth. The Oracle of Omaha himself attributes his success to the power of compound interest and the discipline of long-term investing. His philosophy, often referred to as the Buffett way, is not about chasing quick, risky returns, but steady, long-term growth. We then explored the power of compound interest, often dubbed as the eighth wonder of the world. It's the cornerstone of Buffett's wealth-building strategy and one of the most powerful tools in the financial world. Remember, the earlier you start, the more time your money has to grow and multiply. Moreover, we heard from other financial gurus. Their wisdom echoed Buffett's sentiments. Patience, discipline, and understanding the basics of finance are fundamental in building wealth. It's not about getting rich quick, but about consistent growth and avoiding unnecessary risks. These timeless money tips are not just for the financial enthusiasts among us. They're for anyone wanting to take control of their financial future. Whether you're just starting out or already on your journey, these principles can guide you towards financial success. In this ever-changing world, it's crucial to adapt and learn. But some things, like the wisdom of financial gurus and the power of compound interest, remain timeless. And it's these timeless principles that can guide us on our journey to financial success. So, Let's take these lessons to heart. Let's strive to be patient, disciplined, and always willing to learn. Because the journey to financial success is not a sprint, but a marathon. If you found this video helpful, go ahead and smash that like button. And don't forget to subscribe to our channel for more financial wisdom. Remember, your journey to financial success starts here.